show up not with fancy speech, but they would show up all over the world with their checkbook. And that's where you would find them going to Africa and Latin America, financing and investing in new ports in developing countries to secure rare earth minerals, as well as those raw materials like lithium and copper that lie beneath our modern lives. Things like data centers and batteries and even the cell phones in our pockets that rely on those materials. And so we're witnessing a shift. We're north. We all control. Again, so make that do and this see and doing it at again the data to do pin just straight out the day. Now it's one fluctuate. Gain was 121%. For a safe asset to go up 121% seems pretty volatile to me. And then lose 28% like it did in 2012. And it can, in any year, and we already saw that with silver prices coming out the gate this year, that it can swing 17% in any given year. And so for a safe asset, I think that is very interesting because it sure does act like a stock. And if we track that over time, it's had CD-like returns. It's beat inflation, which is great, but CD-like returns. And lastly, I'll say, and me and a gentleman were having a conversation about this just the other day, as he said, I can't milk gold. And I said, spot on, you can't milk gold. It doesn't have any cash flow or dividends. And so you don't receive any cash flow. It doesn't reproduce itself. The only way it becomes more valuable is until someone decides to take it off your hands and they're next in the order of musical chairs. Now you can see the performance. The S&P beat the Russell 2000, these smaller companies here. And we do think that with lower interest rates, that may switch places. Interesting enough, even with a pro digital currency administration, you saw Bitcoin actually divert away from the market because the market and Bitcoin have had some correlation, but not so much in 2025. Now, you might be wondering, well, can the market continue to go up and up and up? Why is the market continuing to go up? Well, if we look at the S&P 500, that index is a great index in that it recycles the losers and replaces the losers with winners. It's constantly changing the mix that is of the 500 largest companies. Now, for example, you can see in 1985, everyone thought AT&T, GE's dominance were untouchable. I mean, these were the behemoths of their times. You can see right here how large they were. But fast forward, after time continues to pass, they start to lose and be replaced by very large firms like Microsoft and Google. And they get pushed off that top 10 list and recycled with larger firms. And so I wanted you to ask yourself, look how large these companies are. They represent 40% of the S&P 500's returns. But what's the chance that these 10, yeah, sure, they'll be around in the future, but what's the chance in just the next 10 or 15 years that they're actually any of these are on the list 10 years from now? Because that's how fast our economy changes and adapts. And so you have to be careful if you're picking individual winners, because those winners won't stay at the top. Now, that winning streak is not always even. We have a 12-sector economy. That 12-sector economy, if we zoom into financials, is made up of hundreds, potentially, thousands of companies in that one sector. And so you can see that since ChatGPT's launch in 2022, it set off one of the most intense technological investment into data centers and infrastructures and even energy like we haven't seen since the dot-com crash. So it's been amazing to see this AI investment boom with OpenAI deciding to invest a massive amount over the next few years. And so you can see this triple-digit returns over the last 3 years. Again, unsustainable, but it's nice to see and it's great to see. And that's where you're starting to hear all of these mirroring of the dot-com crash concerns. So NVIDIA and Broadcom and other semiconductors, again, have seen extraordinary growth. And I do continue to think and value this type of technology. But to see them get out over in front of their skis with that investment can lead to major pullbacks. The next thing I want to talk about is cash on the sidelines. And this is really important because this chart shows the rise in money market funds, those that are sitting on the sidelines. And this is really interesting because this actually is a bullish sign for the stock market. Because when this cash accumulates, stocks have actually performed better than average following periods of peak money market funds. And so the reason is when investors see these high double-digit returns, sadly, they actually get out of the safest asset and buy at a high and sadly sell at a low. So it's actually a very interesting phenomenon. While I will tell you personally, and we're having lots of conversations about this, it's important for you to have 3 to 6 months of income at all times. And many clients, they should have minimally 30, maybe 50, maybe even based on your net worth, $100,000 in emergency funds of checking, savings, money market, and cash. But anything above that, you start to fall behind inflation. You start to see diminishing purchasing power. And really, you're diminishing the generational wealth that you're leaving behind because of what you're familiar with. And so you may already know our strategy as we take out parts from the wall account, typically 10% stakes from the wall account. We are moving that up into SNOX, quote unquote, SNOXX. It's a money market that earns a very competitive interest rate. What we're slowly doing is layering that in when the market gets very volatile, allowing us to have this dry gunpowder set aside so that when there is opportunity, we can strike and use that money market. And so I would encourage you, if you have money in local banks, it's a great time to put it into a money market in stocks so that we're ready to deploy it if we have any market volatility in 2026. Continuing on, let's talk about real estate. And so we're seeing actually a demand for housing is slowing because of higher home prices. And there's a lot of reasons for this. Higher current mortgage rates. People are in and locked in, not locked in by land, not locked in by an easement. They're locked in based on the current interest rate of their home. And we see declining immigration. So all of that can lead to higher home prices. And so this housing a supply of new homes is rising. So the bottom line is the following demand is actually rising supply and putting downward pressure, on home prices, not upward, but downward pressure on home prices. So very interesting chart to see the average number of offers received per sold property. So what is underneath the hood? What is driving market performance? You've seen this chart. This is something we bring up every year, is the speedometers that lie within the economy. And so this time last year, the economy was and is still operating on full engines, going full speed, and the speedometers continue to fluctuate all throughout 2025. And so we kept a very close eye on all these speedometers. And back in January, we had a lot of green, we had a few yellows, and we had some reds up there. And so let's talk about the visible positive indicators that we started with in 2025. We had the labor market with very low unemployment, which was great to see. Everyone that has a job can obviously spend and boost the economy. We also saw business outlook from companies. Companies felt really good about this AI revolution because they felt like they could increase their margin. They could use this technology to save money and, again, have higher and larger profit margins and accrue some of their own cash reserves. Now, if we look at 2026, where we are a year later, let's take a look at that. You can see that we have a lot more yellows on the screen. We also have less geopolitical risk with some of the trade tensions being cleared up, which is exciting. Energy costs are low. Energy, of course, is a fundamental driver to the inflation that we see. Every goods that you touch has its basis in the energy prices to get it to you. And then we also saw fiscal policy is really positive because of the big, beautiful bill. We were all on bated breath, like, are we going to all pay about 3 to 5% more in taxes, or are we not? And that was figured out. Now, we still have some negatives. We still have that equity market valuation that is overheated. By every measurement known to man that I'm aware of, the 5 main ones that we look at, all thermostats red hot and still are, and in some ways got worse. You also see, though, and this is probably the more insidious one, is that consumer sentiment. The confidence that we have as consumers is degrading as faith in the economy is kind of turning pessimistic, with the inflation kind of choking out our savings. Now, if we look at companies' earnings, like I was telling you before, we have a 12-sector economy, and that growth is never going to be evenly distributed. This graph shows that year-over-year growth between earnings, and you can see that the green is the growth sectors and the gray is the value sectors. And so you can see, obviously, tech is in the lead, but several value sectors offer above the index in earnings per share growth, which is exciting to see. So overall earnings for the S&P 500 companies is growing close to 15%, which is a good sign that companies are operating with very healthy profits over time. Now, this is a very colorful chart, but I love seeing this chart because it shows you the 4,100 data centers that the U.S. has comparatively to the other countries. So data centers are the backbone of the digital economy. That's where all information is being stored and managed and processed. And this has become because of some of our tech giants. You know, we have 38% of all the facilities here in the United States because of Google and Microsoft and Amazon, AWS, having all of their extensive cloud infrastructure is right here in our soil, which is fabulous to see. And so, again, OpenAI, I was sharing with you that earlier, is making a historic build out of digital infrastructure that's going to be used because of ChatGPT's obvious use. And we're talking about a 1.4 trillion with the T commitment. And so again, hopefully it's sustainable. Again, you have to have these companies building this infrastructure, this roadway that other future companies that will come, that are being actually created in someone's basement right now, that we're going to need on the shoulders of this infrastructure. Now, this is probably the most exciting, and it warms my heart to see, probably the most exciting trend is business applications. In this country, small businesses are what makes our economy the most resilient and I would say diverse and developing economy in the world, because we have this entrepreneurial spirit that's just so innate in America. And so this is really exciting, because if U.S. small businesses are behind the innovation that we see in this country, not just big business, that will continue to drive the heritage of innovation that we have into the future. So very exciting sign. Now that was all positive. Now it's time to not be so positive, and I hate to shift it to be more pessimistic, and this is one of the charts to do it, and that is consumer spending in this country. We have an anemic savings rate here of 3.5%. People are only saving 3.5% of their income. This should be closer to the gold standard of 20%. That's the target. 10% we can live with, 15% is ideal, but 20% is the gold standard. And as a comparison to other generations, just to give you an idea, in the 1960s and the 1970s, we saved 11.7%. And there are countries in the world that do save close to 20% of their income today. And so we found that in 2020, the peak in savings hit 32%. So what that tells you, if you strip out stimulus and people start to be conservative and disciplined, we have the ability, your grandkids, your children have the ability to save 12 to 15% of your income. And I am tired of hearing people complain about how they can't afford a home price, but the average screen use for a millennial and Gen Z is close to 30 hours a week. So that's almost a full-time job. So I think that we could probably, if people got their work ethic up, we could fix some of these issues. And so you have generations that if we continue, we'll not be able to retire like you are enjoying today. And no amount of inheritance will be able to sadly fix that. Now, we have been led by a poor example. Consumer spending, compare it to old Big Brother. Big Brother government spending looks quite awful too. If you look at this chart, this shows inflows versus outflows. And I'll let that sink in for just a second. I can only speak for me, but what's concerning is this other column. This other column, I'm starting to get really interested in other with government spending, because after those Minnesota daycares, I'm really interested in what that other is starting to become. 17%. I mean, our spending is 7 trillion with a T. We're running a $2 trillion deficit. T should be for time out. Like, we need to figure out, like, why are we spending so much? And the issue is, what other job or revenue source does the government have? They don't drive Uber on the weekends. There's no gig economy for a country. They look at you as their revenue source. So my concern is, if we don't start getting this taken care of, they are going to start looking at the largest portion of money that's out there is the trillions of dollars that sit in your 401k and your TSP and your IRA. So where are we headed? This is a chart we show, or a graph that we show every time. And this is a mainstay slide because the Wall Street's finest, every State of the Market and Halftime Report, we show this because this is Wall Street's finest outlook on the market. And you can see that across the board, all of the analysts from the largest institutions think that the market is going to end positive with a target of 7,600 on the S&P 500. Now, you and I both know, if you've been to one of these before, that Wall Street's finest don't do such a fine job with actually predicting the future. Now, I'm not Nostradamus myself, but without a debate, it makes a really big case that if markets are overvalued, and this is why, again, I hope the market continues to go up. It's great for business when the market goes up. But we have to understand and start setting expectations of role-playing what a market correction could look like. And I've been very proud to sit in on reviews, hold reviews, and be proud to sit back and look at the financial plans that you all have because of the wall accounts and the foundational accounts, those accounts that zig when the market zags, are so well funded. And so I'm really excited that during this year, we're going to continue to keep a close eye on the percentages that are in the walls. Typically, and this is homework for you if you're taking notes, we want to see 30 to 60% in wall accounts. So if you get back home and you look at your fiscal house, you want to see typically 30 to 60% in those wall accounts. And what I've witnessed is that's the case. So if you, and second homework item is if you have big purchases on the horizon, you see renovations on the horizon, or you're increasing your monthly spending in 2026, you're going to give yourself a retirement pay raise. You go do it, but let us know about it so we can make sure that the cash and the financial plan has been adapted accordingly to make sure that if there's a market correction, that we're not going to have to put the brakes on anything. The other point I want to make is we will be holding and not processing any Roth conversions this time so far this year. We're not going to not do it. It's that we're not processing them anymore right now. Why? Because the market is at all-time highs. That is not the time to do a Roth conversion. It is a great time to do your qualified charitable distributions to a church or charity. So if you were thinking about doing it later in the year, this might be a great time to do it while the market is as red hot as it is. So let's continue. Let's talk about oil because this has been a big topic of discussion. And so I want to talk about this because I want to get it very clear out there. The U.S. doesn't need anyone's oil. As you can see, we're in the top 10 with 45 billion barrels of oil. I think we're doing just fine. And if you look at Saudi Arabia as well as the United States, we have some of the most efficient output of this oil. Now, of course, Venezuela holds the total of 17% of global reserves that have been secured by a country. And so that's great to see. But sadly, as we've seen over generations of many reasons to blame, their actual output has continued to decrease. And so why is oil such a big deal? Well, it's one of the reasons why we don't have more inflation than we already do. So it's important to keep oil prices low because it's what keeps inflation low. The second is we're going to need all forms of energy, especially oil, to fuel the next wave of innovation and technology for the future. Now, lastly, I want to talk about this because here's what you don't see. And I don't see the media talk about this enough, but I do have again, a guess that you might see this over the next 5 years is a conversation about oil. You don't have to ever worry about oil running out. How can I say that? Because what's not on this chart is 500 billion barrels of oil that sit right below Chile at the top of Antarctica. And Antarctica's big peace pact is coming up for debate soon enough. And so there's 500 billion gallons of oil right there, double that of Saudi Arabia's. If we talk about Fed Chair Jerome Powell and Donald Trump's glowing relationship, how they've been best friends for the last few years, we've seen a lot of conversation about interest rates. And I've been very clear on my monthly market recaps. I'm sure you've been watching them, and you've heard me say about my opinions that I don't like the focus on interest rates because we're not communist China, we're not a socialistic country, or we're not supposed to be. And so this emphasis on interest rate is perturbing. But I will say that Jerome Powell's tenure is coming to an end. He's got this recent January meeting, he's got April, and he's got a March meeting, and then he is going to still be on the board, but he will not be chairman. And so with the new chairman, we expect to have a conversation about lower interest rates, which will help things like Signet and real estate start to have more activity. So again, this one cut next year business, I think, will be pushed aside. This is the most interesting chart of this afternoon or evening and it's a complicated one, so I want to break it down really quick. The blue represents the current valuation that we are today, the 1-year horizon, where possible returns in the next year could go. Now, if you look at this, it basically says the market could lose 26% or go up 40%. Well, that's not really helpful because there's a lot of numbers between those two. But what this is showing you is that a PE ratio, a price to earnings ratio today, over the next 5 years actually gives you a more predictable layout. And you can see there's a lot of concentration with the current market valuation that we might over the next 5 years see only a 6 to negative 3% return. I don't know about you, but that is very underwhelming. If we continued, we always must understand that we are a United States of America and that we are made up of these tiny, distinct states and larger states of economies that fuel the overall GDP that this country has. And as of October of last year, 23 U.S. states face high recession risk or are already in recession. By contrast, 16 states, including yours truly, the Sunshine State, and Sweet Home Alabama, are expanding based on Moody's. And so in 2025, states were responsible for a third of U.S. GDP. And here's why this is going to be continually a topic for discussion, is that California and New York make up nearly 25% of U.S. GDP, but are treading water. And we're going to have more debates about fraud and government spending to these states that are not being ran very well. So political or not political, that's a concern. So let's talk about the tangible strategies that we're implementing. And we don't outsource money management here at SWAN Capital. We don't outsource it to London, New York City. And I'm very proud of Lucas, who's at the helm. He's a CFA, CFP, managing that portfolio team, doing a fantastic job. And we made a lot of different strategies with our portfolios that have paid off. And these profitable pivots have really paid off. And this is why it's so important. When we don't outsource money management, we have a closer feel with these portfolios and understanding why they're working so well and when they're not working so well. And then, as I've told you many times, that's where all 20 plus team members' money is. That's where Lucas's retirement, my wife's retirement, my retirement is. And so I'm very proud to show you the net returns for SWAN Aggressive at 15.4%. SWAN Growth at 14.3, SWAN Dividend at 10.2, and SWAN Balanced at 11.5. And we've stress tested like SWAN Dividend making 10.2 net of fees, but that's not even including upshifting and downshifting when it has, based on a downside, has like a 20% or half of the market's pullback if we saw another 2008. So very excited about the profitable pivots we've made by decreasing tech, increasing more dividend paying stocks, also making sure that we have good exposure to international because of how underpriced it is comparatively to the domestic market. But Lucas and I are not resting on our laurels. And I do believe there's going to be another shift in wealth management where we used to start with mutual funds that were clunky and heavy in fees, not transparent. We've evolved into ETFs, utilizing transparent, connected to indexes. But the future and where we're headed is what we call direct indexing. And you can see all the clear advantages. And so we're not ready to roll out direct indexing, but we will over the next year or so to be able to strip out those companies that are not founder-led, because founder-led companies tend to actually do better. Makes sense. If the person that founded it has the most heart for it, you want them to stick around. Number two, we're stripping out those companies that are not profitable. We're stripping out, and I hope you like this, things that don't align with our belief structures. We're going to start stripping out some of those where instead of hundreds of companies within each ETF, maybe only 30 or less. This is a very powerful chart to show you one of the largest risks to your individual retirement. And that is called sequence of returns risk. And I want you to see this because it's a fantastic illustration of why we build a fiscal house that's made for all seasons, not just summer and spring that we've enjoyed so far. As retirees, this risk is a big deal because it shows you that if you lose money in the first few years of your retirement, it sets the tone where you could run out of money in less than 20 years. But if we have great returns in the beginning, even if we have bad returns in the end, we still end with more than what we started with. And many of you that have been clients for a long time have actually seen that your net worth is still growing while we've been taking money out. And so this is why we have wall accounts. This is why we do some of the upshifting, downshifting that I'm about to unpack with you right now. And again, I can't dote on our portfolio management team enough. This represents the upshifting and the downshifting that we did in 2025, where in 2025, in Liberation Day, the market went down double digits, but we were actually in a buying behavior, upshifting 10% into more growth and aggressive-oriented portfolios. But then when the market kept on hitting all-time highs after all-time highs, we started downshifting and downshifting, being proactive, not trying to market time, but keeping a cool head under those exciting, exhilarating opportunities. Again, I made this point to talk about at least twice today about Roth conversions. Again, we are preparing for Roth conversions throughout 2026, but we are not processing Roth conversions until we see market volatility. And I love this chart because I'll use this one as an example. Let's look at a year right here. So in this year right here, the market went down 10%. So if you weren't careful and you tripped up and you actually were selling when the market was down 10%, you missed out. You missed out on 24% returns for that year. When the market goes down like that, that's the perfect time to do Roth conversions and do it on a smaller balance so that when the recovery happens, it's all tax-free growth. So I'm very excited because we have a longer runway till 2028 until the big, beautiful bill could be potentially repealed by another administration. The second is the other wall accounts and types of introduction of other asset classes that we've done for clients. And so we have a total of 2023, 2024, and 2025 and 2026 Signet funds that have been created, and we've already rolled out our 2026 SWAN Nest Fund. And I'm really excited about these private funds that are available for any accredited investors. Clients that have over $1 million net worth excluding their home have access to these private funds that we have. And so if you are already a client that has money in Signet 2023, I'm excited to share a very exciting announcement. I put in already $400,000 of deeded over property to Signet 2023. I'm putting in $500,000, I think next week, of my own capital in 2023, because this is where SWAN Headquarters 3.0 will be. And I'm building 6 townhomes, which I think I can build them for around $400,000 and look to sell them for the 700s. And so this is a great opportunity that if you're an investor in Signet Fund, those who are owners of Signet Fund 2023 will get to experience. But maybe you're not in Signet 2023. Maybe you're in Signet 2024, or maybe you're in Signet 2025. I want to share with you the progress of one of the properties that we've been renovating in 2024.
It would just be this.
So these are the renovations that we're making to properties that are paying off very well, and we're already seeing exits in 2023 and 2024 that will be being paid out as dividends very soon. And so I'm very excited about the exposure to 20 US states, 80 properties, $60 million invested, and just the beginning of dividends starting to roll out for those invested in Signet. And so if you're not invested in Signet, this is one of the great opportunities while the market is at all-time highs. And then we rolled out SWAN Nest last year that gives exposure to private credit and energy, which we're very bullish long-term on both of those categories, which again, as you can see, have different risks than traditional bonds and different risks than the market because oil prices are not directly correlated with the overall market. I'm also very excited about sharing an update that Mike Burnett will be the the tax preparer that will be meeting with clients throughout this tax season. And so we're very excited about having a meeting in Pensacola as well as Daphne. So if you haven't already filed your taxes for 2026 because you're still waiting on some tax documents, definitely get scheduled with Mike. He'll be meeting with clients to chat through all the big, beautiful bill updates, which there are plenty to go over. And so if you haven't got it in the mail, it's all the information on his contact information. You can see his phone number there, and you can call the schedule and get on his calendar today. And he's going to have access to our team to get those tax documents for you. Scott, anything you want to share out there? All right. So the big, beautiful bill is very exciting to see the permanent structure to the estate taxes, which applies to a small percentage of our clients, but it is very exciting to see this type of tax law be instituted for families. I'm very excited to share with you the new team members. You know, anytime you're adding new team members, you're going to have some growing pains, and I thank you for the patience as they continue to learn. But I constantly want to hear the feedback. The buck always stops with me. If there's anything that's ever, substandard, if you're thinking it, I want to know it more than you want to share it. So if there's any ways that we can improve, please let us know. Write me an email, call me, say, hey, I got to speak to Andrew. I want to know, because these are great team members and they're in their learning phase, but we want to help them progress in their career. Let's get to those questions, Lucas.